I want you to imagine this just for a second. It's April next year. You're sitting at your desk, your tax return is done, and you're staring at a number that you don't like. And the worst part isn't the number. The worst part is realizing you could have done something about it, but that window is already closed because tax planning is not about what you know, it's all about what you do before December 31st. And today's episode is the final episode in our year end tax power series. And this one's different. This is the episode where we talk about the moves that are irreversible after year end, the strategies people always say, I wish I had known about sooner, and the quiet decisions that separate people who build wealth from people who just make good money and then watch it disappear out of their hands. If you're a business owner, investor, or high income earner, then this episode can literally decide whether you keep tens of thousands of dollars or hand it over to the IRS by default. Here's something most people don't want to hear. The IRS does not care if you meant to buy the vehicle. They do not care if you plan to set up the retirement account. They don't care that your CPA mentioned it in passing. If it's not done by December 31st, then it doesn't exist. Every year, I meet smart, successful people who say things like, I was going to do bonus depreciation next year. I didn't know the payroll had to be run before year end. I thought we could just fix it at tax time. You can't retroactively create strategy. You can only report what already happened. And today, we're talking about the moves that must happen before the clock runs out. Let's start with one of the biggest ones. That's bonus depreciation. This is a strategy everyone hears about, but almost no one executes it correctly. Here's the simple version. If you buy certain business assets, equipment, vehicles, short-term rental furnishings, and place them into service before year end, the tax code may allow you to write off a massive portion of that cost immediately. But here's what people get wrong. They treat bonus depreciation like an excuse to buy something that they don't actually need. And this isn't tax planning. This is just retail therapy with the 1099. The correct order is always make a good economic decision and then ask, how do I get the best tax treatment for this? The tax tail should never wag the economic dog. And now, where bonus depreciation does make sense are vehicles that you already plan to buy, equipment that you actually use, furniture and appliances for those short-term rentals, technology, cameras, computers, podcast gears, assets that increase revenue or reduce operating friction. And here's a critical rule. If it's not placed into service before December 31st, then it doesn't count. Ordering it is not enough. Financing it isn't enough. And talking about it is not enough. Now, vehicles deserve their own moment because this is where people get emotional and stupid, quite frankly. I heard I can write off a G-Wagon. My buddy said that my truck's fully deductible. Or I saw on TikTok, it's over 6,000 pounds, then it's free. Let me slow it down. Certain vehicles can qualify for accelerated depreciation, but that does not mean that you should buy something that you can't afford, that you should stretch your business just for a write-off, or that you get a free car from the government. A deduction reduces taxable income. It doesn't eliminate the cost. A tax deduction is a discount, not a refund. This is where planning matters. You got to look at your business use percentage, entity structure, basis limitations, especially for US Corp owners, and whether the vehicle actually supports income generation. If you want to do this right, this decision happens before the purchase and not after. Now let's move on and talk about one of the most misunderstood high income strategies, and that's oil and gas intangible drilling costs, or IDCs. This is not a hack, it's not a loophole. This is a long-standing part of the tax code designed to encourage domestic energy production. And here's why people use it. Got certain oil and gas investments allow deductions that offset ordinary income, not just passive income. That means that your W-2 income, your business income, and not just capital gains can be offset. And here's why people misuse it. They chase deductions without understanding the risk. They invest money that they actually need, and they assume these are guaranteed rates. If the tax deduction is the only reason you're investing, it's the wrong investment. Oil and gas can make sense when you're a high income earner, you've got a lot of liquidity, and you've got a risk tolerance that you can accept and handle for these types of investments. And the investment stands on its own merits. It should never be your first move, but for the right client, it can be a powerful tool. Now let's talk about charitable giving. Most people give like this. They write a check, they feel good, they move on, and that's fine. But when your income spikes, we want to be intentional. And there are smarter charitable strategies. These include things like donating appreciated stock instead of using cash, using donor advised funds to front load deductions, coordinating charitable giving with those high income years, and using qualified distributions later in life. If you're already giving, the question is not if, it's how and what makes sense this year. Tax loss harvesting is another strategy that sounds simple, but it gets butchered all the time. Selling an investment at a loss does not magically save taxes. Your losses offset your gains, or they carry forward, and they live in specific buckets. And what matters is the context. Selling at a loss without a plan isn't strategy, it's just an emotional decision. Now, crypto deserves a special mention because under the current rules, watch sell rules don't apply the same way, which creates a planning opportunity. But again, this only makes sense when it fits into your overall strategy. This is a strategy that almost everyone ignores, and it's one of the easiest if your cash basis is paying your expenses in December versus January. Timing your invoices and client payment timing matters. Timing isn't cheating, it's how the tax code is written. And that's why business owners are at Costco on December 31st buying supplies, equipments, tools. They're pulling forward those expenses that they already planned to incur. And that's why some intentionally delay income for a few days. Small timing decisions can move thousands between tax years. Now let's talk about paying family and where people get it wrong. Because paying family members is a powerful strategy, but only if it's for real work. You cannot deduct or decide in March that you paid your kids last year. You can't backdate the work or invent roles. If you want the deduction, the work must be done. You must have made the payments, and the structure should be right. The IRS doesn't hate family businesses, they hate fake ones and people being fraudulent. This is about shifting income to lower tax brackets, teaching your kids responsibility, and keeping money inside the family ecosystem. But it has to be executed properly and before the end of the year. Now, I want to end this series with something honest. Every year I see two types of people. The first says, I wish I had talked to you sooner. And the second one, they say, I'm glad that we planned ahead. The difference between these people isn't intelligence. It's not their income level. It's not even discipline. It's decision making before deadlines and taking action. Wealth is built by people who act early, not by people who react late. And if you've listened to the series and you thought, I know I should be doing something more, I don't want another year of overpaying the government, I need someone who actually understands this, here's what you should do. Go to bristertaxlaw.com. Go schedule a tax strategy session. I'll review your last return. We'll identify moves that actually apply to you, and we'll build a plan that you can execute before the end of the year. And we'll help you stop leaving money on the table. Information alone doesn't change the outcome. Execution does. I'm Anthony Brister. Thank you for listening to this series. And if you're ready to take control of your tax plan, please reach out. And if you found this video helpful, please share it with someone who you think it might help. Subscribe, comment. It really helps get the word out, and I appreciate it. Thank you, and we'll see you next time. Thanks for watching. If you found this helpful, go ahead and give it a thumbs up. Drop a comment below. And if you have any questions or thoughts, I always try to respond. And if you haven't already, hit that subscribe button, ring that bell so you don't miss out on the next video. And if you want to go deeper or grab the resources that I mentioned, check the description below. I've got all the links, tools, and next steps for you there. And if you're ready to talk about your specific situation, you can also schedule a free discovery call using the link in the description. Just pick a time that works for you best. And if you know someone who could benefit from this, feel free to share it with them. It really helps spread the word